Hi, everyone. Welcome. Thanks for joining us today. I'm Hope Wood. I'm Andromeda's head of business development and delighted to have joined the team recently. I have with me today Alberto Gallo and Aditya Ani, who are going to be discussing some of the views, catalysts, and trading opportunities from our recent Outlook note, the Silver Bullet, which we sent earlier this week. I think most of you probably know Alberto and Adi are the co-founders of Andromeda, and they're planning to do a short presentation and we'll then follow up with questions. So feel free to submit any questions that you have in the chat. And with that, Alberto, Adi, I'll let you all take it from here.
Thanks, Hope. Thank you, everyone, for dialing in. We're going to be very quick here, and we want to discuss the outlook for macro and credit and the opportunities that we're seeing. So I'm here joined by Adi. We're going to go into a brief Q&A later on. So the first thing I'd like to say is that this is a very, very exciting environment for credit markets. It's probably the most exciting that we have seen in our careers, both because there is a lot of volatility and because there is a lot of dispersion. If we think about the recent sell-off that we had, we really had not a systemic event in the market, but a lot of things have sold off in a sort of systemic way. Let me show you a few things and run through the major dislocations that we have seen so far. So, our macro outlook is essentially that we're going to have a bumpy ride. We're going to have some speed bumps along the coming quarters. It's not a recession, but there's going to be some volatility down the line. This volatility creates opportunities, creates also dispersion for investors, especially if investors can be tactical rather than always fully invested in the asset class. As you know, we're particularly focused on credit and rates, and we have seen since the end of last year, since the beginning of the rate hike cycle, that central banks are really trying to manage this hike cycle with a little bit of stick and a little bit of sugar. So they hike, inflation is persistent. We continue to see persistent inflation. Central banks hike, then when something breaks, they try to give some sugar to the market. It's almost something that, someone has called it quantitative teasing. It's not QE anymore. There's still hawkish conditions. There's still a hawkish monetary policy, but they are giving some sugar to the market. In particular, in this particular case, the term funding program of the Fed and the liquidity injected into banks. But even last year, we saw it with the LDI crisis. We saw a pivot. We see that essentially we have to live with a period of persistently higher inflation. And the reason is that there's changes in politics domestically, there's more fiscal policy, more spending, and there's changes in geopolitics where you have more tensions between China and the West. And China is no longer an exporter of cheap labor. The median wage is now around $8, which is 4 times what it was 10 years ago. So we are in a scenario where monetary policy is no longer the only game in town. Fiscal policy is there and will continue to be there. And inflation is in part supply driven, but going forward is more and more demand driven. So does this mean that the soft landing is no longer possible? Well, in our case, we're in an extended late cycle scenario. We still see inflation higher than target, around 3.7% at the end of the year. And there is a recession probability that's higher than 0, but we shouldn't panic from the fear of a rolling recession, coming every 6 months from now. What we should think about is that, despite the recession probability, there's a lot of it is sometimes priced into assets, into the credit market and the rates market. And so, we still see inflation above target. We see some probability of a recession, but we also see a lot of markets where this recession probability has been priced in and perhaps maybe too much compared to the actual probability. That the actual likelihood of this recession, which according to our model, went to 50%, and now it's below that. So in particular, what are central banks doing? What's the policy reaction function to to the difficulties that we have seen. So what we see is that central bankers are still reducing their balance sheet. There has been some liquidity injected. We had essentially a balance sheet increase recently of around 390 billion, but over time, we still have quantitative tightening. And the ECB is also behind the curve in its hiking rates, remains hawkish. We saw recent comments by Schnabel, who is the leader of hawks, and even the Bank of England, who's been behind the curve for a long time, is hiking. So it's what we would call quantitative teasing. The hawkish cycle continues. There's too much of a dovish bias priced into the US market, and also maybe in the European market, there's a touch of dovish bias. So essentially, we don't see a lot of value in rates. Governments continue to spend. There is a lot of tightening, a lot of cuts priced in. The rates has been calling for a recession for a very, very long time. We think that's too dovish. And even if there is a slowdown, we do think that unemployment needs to go to 4.5% in the US to trigger the Fed, to make the Fed push, to make the Fed break the emergency glass, break the glass and start cutting. So we don't see a lot of value in rates, but where there is value sometimes is in the spread market. We had the events of the LDI crisis last year, then we had crypto, then we had Silicon Valley Bank and Credit Suisse in Europe. And we do think that there are some issues in the financial system. Financial markets have been used to over 10 years of QE infinity, and now we are withdrawing this stimulus, like a patient who has been on an anesthetic for 10 years and now is trying to walk. There's a lot of organs that don't work, but the organs that actually are okay are the banks, where regulators have been focused on for the past decade, fighting the last war. Especially European banks have raised capital, so we have been pretty cautious on credit markets since our launch, since the end of last year. And our argument was that, inflation is persistent, not transitory, which was proved right, and that central bankers would not be able to pivot completely. And so we didn't buy the pivot that we had last year, and rates rewidened. And also what we said is that the rate impact on credit markets and on risk markets was very muted. And so finally, spreads have been widening. There are areas of the market which are breaking. But there's also, in the process of repricing, there's also many areas which indiscriminately are selling off and provide opportunity. So in this case, what you can see here is that European banks have shrunk their balance sheets and increased their capital over the last 10 years. And they're actually on average better capitalized than US banks, even though it's a slightly different system and they're bigger as percentage of GDP. But if you take Deutsche Bank, for example, it has reduced its balance sheet from around 1.8 trillion euros to 1.3. So it's obviously less systemic than it was. So generally, we do see other issues in the market, but they're probably not in the in the banking system. They're elsewhere in the world. And in particular, we are more concerned about the US part of the banking system compared to Europe, where you see that there are still banks with high exposure to commercial real estate and high exposure to hold to maturity assets. But generally speaking, the contraction that we have seen in credit is not enough to trigger the contraction that we've seen in banks. And so the sell-off in banks, the increase in bank spreads is not enough to create a contraction in credit, especially mid-tier banks in the US. In particular, they're 20% of credit supply. They used to be 30% a decade ago. And even if that credit supply contracts a lot, it can get absorbed by other institutions. So they're not even a quarter of credit supply. So generally what we are seeing is there is a lot of speed bumps. We expect more volatility. We expect more volatility in particular towards the middle of the year, when the BOJ will have to exit yield curve control, which is the anchor to long-term yields and controls the real pain, the real quantitative tightening in the belly and the long end of the rates curve. So we continue to see central banks not cutting. The Fed cuts are wrong in our view, and we have been fading that. And the ECB remaining hawkish because core inflation is still there. And we continue to see this this trend of hawkishness for this year, for the next month, spilling over into wider spreads and volatility. But having said that, we're also in a backdrop where corporate fundamentals are very strong. The central bankers themselves have complained about corporates increasing their margins with inflation, so using inflation as an excuse to make more money. It's a very different scenario from the 70s, where workers have bargaining power, and here it's corporates that have bargaining power, and corporate profits are growing. And as a result, when we see credit that's priced for a recession, we want to buy it, because there's solid yields and solid areas of the market that are dislocated. So here's essentially what is happening in terms of market opportunities and where we're deploying our capital since our launch. We have seen an environment of, unlike the pre-QE environment, we are in an environment where there is short-lived but more frequent windows of opportunities for deploying your capital, which means that probably a buy and hold strategy, a carry strategy, which is a typical thing in credit markets, is not necessarily the best thing to do, as it was during the QE period. Instead, what you want is something more tactical, that is able to understand the turning point in the market and deploy capital at the extremes. Essentially, that's one of the things that we're trying to do here. And the other thing that we do differently is that we always look for positive convexity. So we're not vol sellers, we are vol buyers when vol is low, and we sell it at the extremes. So in our portfolio construction, if I want to summarize the longs and the shorts that we like today and where we see opportunities in the market, and Adi is going to go in more depth on these and some of our top longs and top shorts. Essentially, we always look for upside, we always look for downside, but we have a core portfolio which is now made of strong companies with resilient yields and some capital appreciation upside. So where is our core portfolio? It's mostly in European names that have stakeholder support in sectors that are defensive. So if we think about staples, gaming, securities, industrials, some financials, some energy. And generally, we like credit and we don't like rates, because we think that inflation is persistent. Our models tell us that inflation is above target, and we continue to see that central banks will hold rather than the cuts that are priced in. So we generate pretty good coupons from this and some capital appreciation from this core portfolio. But there's also upside convexity and downside convexity, and they're not exclusive necessarily. We could have a scenario where both our longs and our shorts go well. The upside convexity is mostly in Europe and mostly in areas where default risk is priced really high. So where is the opportunity? Tactically, it's in banks, and particularly in some of the banks which we like are the more resilient ones, the commercial banks, the ones that have a bondholder friendly policy, and not necessarily only in the most subordinated capital, which is AT1s, but also in lower tier 2s. But also across corporates, when you see that a lot of defaults are priced in European markets against history, and when you look at the government support that governments are giving to companies, and the names that are in high yield, which are much higher quality than some of the US names, then you're really thinking about the default cycle that's moderate, even in the worst case scenario. Even in a recession, we're not going to have a big spike in defaults. So when we see windows of opportunity, windows of panic, that's something that we like buying. There's also things that we don't like, and we're talking about the consumer, the weakest areas in the world, consumer in the UK, the real estate sector, some specific names that have bad governance, and we'll talk about those in a second. So essentially, in our process, if I want to summarize where we stand, after launch, we're pretty excited. We went from a very bull market, one-way bull market, into an environment of volatility where there is a lot more turning points in the market. Some policy errors across countries. Some central banks are going to be too hawkish, perhaps the Fed, and some other ones are too dovish, like the Bank of England. So dispersion and volatility are good for us. We're still pretty tactical. We went from being cautious to being positive, and from net short to net long risk between February and March. But we're also very aware that later in the year, with the BOJ and potentially more hawkish signals in the long end of the curve in particular, markets could become volatile again, particularly on the areas which are very sensitive to duration. So, commercial banks that have a lot of hold-to-maturity debt, and the private market, which is also not being marked to market yet. And with that, I'm going to turn it to my colleague and co-founder Adi on our two best longs, and so the best long and the best short that we want to talk about today.
Thanks, Alberto. And hi, everybody. So to start with our high conviction long, as Alberto was saying earlier, we're seeing a lot of dispersion across asset classes in the sense that rates are pricing in a high probability of recession, equities are pricing in a much lower probability of recession, and credit is in between. But even within credit, we see a significant dispersion between Europe and the US, and even within different risk tolerances in Europe itself. So for example, just to explain sort of the Europe versus US differential, firstly, European spreads look wide versus US, both on a technical level and a fundamental level. On a technical level, European spreads, especially in things like crossover and iTraxx mean, are one of the more heavily shorted indices relative to their counterparts in the US, which means that the technical backdrop on Europe is far more positive in spreads than it is in the US. And then fundamentally, when we look at the leverage of these indices relative to their US peers, the leverage has been declining at a far more rapid pace in the European indices relative to those of the US. So there's a technical and fundamental case for the European credit relative to the US. Within Europe, the two aspects which are our favorite long are the junior mezzanine tranches and crossover. So that's the 0, 10 and cross, as well as the 2035 and cross. So just to explain, the 0, 10 and cross is effectively, the equity tranche of crossover in a zero coupon format. This today trades around 20 cents, relative to par, which basically means that if there are 10% of defaults in Europe, you could recover 0. But if there are no, that can go from 20 to par. So it's essentially a 5 times opportunity in the best case scenario, which probably won't pay out. However, as you can see on the figure on the right-hand side, the realized losses within these within this tranche since inception of the crossover series has only been a handful of times at around the 10% level since history started. So typically, you sort of realize anywhere from a 20% to about a 50% loss, which means at the current price of 20 cents, you can make double your money in sort of a base case scenario. So this is something which we find extremely attractive. The second point, which is on the left, is that within the crossover names, these are typically benchmark high yield names with implicit stakeholder support, whether it's from the government or as well as from shareholders. Secondly, the 10 to 20% within the crossover, which is just one tranche above the 0-10, today trades at about 50 cents. We entered this at 40 cents. Now, as you can see within the chart, there's only been 2 instances that this tranche has actually been paired at all, which means that over a 5-year period, you will again most likely double your money at this current entry point. So these are 2 things which it's a very unique opportunity which has opened up, and it really goes back to the first point, which is that it's really opened up because some of the technical factors at play here, which is that there's a very large short base in Europe relative to the US and relative to history. So that's essentially us on our top conviction on the long side. On the short side, just to explain this in a bit of a general background, firstly, there are a number of business models which have developed in the last 10 years, which are effectively arbitrage models, which essentially they were buying assets which yielded higher than their funding cost. And these assets would yield today between, say, 2 to 5%. And historically, these might be businesses that were funding themselves between 1 to 2%, which means it made for a very profitable arbitrage, which looked like it would have continued to work into the future as well. Unfortunately, now even at the government rate, that is to say that even if these assets were owned by the government, that arbitrage no longer works, essentially because the asset yields are just too low relative to the funding costs of the governments themselves. One such example of this is European REITs, or REITs in general, but European REITs, where essentially the portfolios of these companies yields between 2 to 5%. Historically, they funded themselves between 1 to 3%. They now need to fund themselves north of 7% in most cases, or between 5 to 10%, which effectively means that there's not a lot of, well, essentially it's a negative funding. It's a negative cash flow business fundamentally. What does this mean? Now, we've seen a huge decline in the equity value of a lot of these companies. They're down anywhere from 50 to 80%, which is that rightfully so. We've seen, a repricing in the equity markets. However, credit has remained relatively tight. And the reason for that is that the LTVs of some of these businesses have not really been remarked. So they're about 40 to 50% LTV, which makes a creditor feel secure in the fact that even if the assets were half their value, you would make back par. But the reality is that, with higher funding costs, these LTVs are much higher, and we estimate they can be, on average today, to say 40 to 55%. We estimate that this could be anywhere from 70 to 85%, which means that, at about 400 to 500 spread, you're not compensated for the risk. For comparison, the tranches we were speaking about before yield double or triple that. And they have much better upside. So this is for us a very high conviction short, and especially compared with the tranches before, which actually have shorter, less duration. They've only got today 4.5 years of duration. As we sort of move closer to maturity, is including the 10 to 15%, which is the senior, the junior mezzanine tranche, which essentially yields 10 to 15%. And as I said before, it's something which held to maturity can you can double your money. And with that, I'll hand back to Alberto. Thank you.
Thank you, everyone. I think we covered a lot. We are definitely excited. As you can see, we're open for business, and we're very, very happy that Hope Wood has joined us in January as head of business development, so she'll be in touch with you. But before, I'd like to check if there's any questions from the audience. Feel free to type them in the chat. Even now, if you want. So I have a question on inflation and wage inflation, which is the key variable we're looking at. This is something that's really developing in Europe, where we have a lot of strikes in the UK and in the Eurozone, including Germany. So our view is that there is the potential for a wage price correlation. We don't want to call it spiral, but there is, and it's particularly in the UK, but even in Europe, we see more persistent services inflation and more persistent wage inflation. But we're not in the 70s, but we have that, and we're happy to send you more on this topic. So I would say that definitely the services and the wages is a sticky component in inflation. There are areas where governments are trying to do something. In France, the price of bread is controlled, for example, and that's a big part of the inflation basket. But the realized inflation, if you actually look at non-controlled prices, is much higher. So we do see that this is a very different scenario from the policy mix that we had before. Before, we had low taxes and low rates, and it was really benefiting the top 10% of the population, or the top 50%. Now fiscal stimulus is going to the bottom 50, and the bottom 50 spend, and the bottom 50 are angry because they didn't get any increase in real income in the last few years. So it's probably something, the wage negotiation is probably something that's going to continue, even if headline inflation comes down. There's other questions, and I'm going to take maybe one, and then one is for Adi. So what's the impact on yield curve control changes in Japan on European fixed income? And here, this is really the elephant in the room. Japan is the anchor for demand in long-term yields, and that's both for Europe and the US. And what we have seen today is that if the 2-year goes to 5, it doesn't really hurt much. A lot of people, 99% of people in the US have mortgages which are vintage mortgages, and they're actually almost running a carry trade with the 2-year. So they have borrowed in the past at low rates, and they are investing with the with money market funds. So the long end does not hurt a lot. It doesn't hurt companies. Companies can borrow with an inverted yield curve and invest at short dated. Unless you really need cash today and you're using a credit card or an auto loan, you don't really get hurt by the 2-year. But if the 10-year goes above 4%, then we are in a lot of trouble. We're in a very different situation, in a world of pain, to quote a famous movie. So essentially, we really need to understand what happens to the 10-year, and if the BOJ exits yield curve control, which is pretty possible later in the year, and that can be one of the factors that leads to a steepening in the curve, might lead to a steepening in the curve, and that is really the scenario where you have volatility. Or you could have essentially a scenario where you have quantitative tightening, additional quantitative tightening. So it's not about so much the short end, which matters, but does not really impact financial conditions. It's the long end that, in our view, really can hurt financial conditions. And then we have a question on SoftBank. So Ali is going to join me again, and the question is there a liquidity trigger that might lead to a reassessment of the credit story by the market? That's a pretty good question.
It's a great question. So just to answer your question, but just take a step back for a second. As we were saying before, there are a number of different funding models that no longer work today. REITs is one example, SoftBank's another. There are countless others, including things like interim.
Yeah.
Now, what we want to do is position more in those which have, as you rightly point out, a liquidity issue or a debt maturity issue, things like REITs. Now,
and we love shorting them as long as there's a catalyst.
Yes. Now, within SoftBank, it's not a liquidity problem. It's not dissimilar to the REITs in the fact that it's an LTV problem and it's a correlation problem. What do I mean by that? So to start with the correlation issue, effectively the LTV is about 35% or 30% as widely advertised. The correlation of its underlying assets has a correlation we estimate of somewhere between 0.7 to 1, which is to say that if one of the assets goes down within, with the LTV, more likely than not, the rest of them are going to go down as well. However, the spread today is priced, we estimate, with a correlation of between 0 to 0.25, which is to effectively say is that the market thinks that their asset base is highly diversified, which it's not. So if the market were to price, a much more appropriate level of correlation amongst its assets, the spread needs to be closer to something like 800, 900 relative to 350 today.
Thank you, Ali. Thank you. And so I think we're going to give the word to Hope again for a final word, and also to check if there's any more questions from anyone else.
Okay, can I ask just one more question before we wrap up? Because it's an important one that I think a lot of investors have been speaking with us about as we've been having meetings recently. And then we'll wrap up. But the question that has come up quite a bit is, if you're an investor, should you just wait and keep your cash, wait for a big dislocation, try to get the returns like you did in 2009, 2020, or should you be putting cash to work now? And I'm sort of leading the witness by asking that to you guys. But anyway, I think it's a very topical one, and one we've been discussing a lot. So I think it'd be a great way to wrap up.
Thank you, Hope. So the short answer is we actually see some pretty good opportunities today, but how do we know that we're going to have a big sell-off? And a lot of people, and maybe we are also sometimes hoping for a COVID type V-shaped sell-off and stimulus, subsequent stimulus, where you can make a huge entry point and deploy capital. The reality is that central banks have gotten a little bit smarter here. They know that they're stuck between financial stability and price stability. And they're trying to guide the market into higher rates without completely disrupting the system. So, we think it's unlikely that we have a scenario where there's a big exogenous shock without a policy response, and more likely that we have an environment of speed bumps, unless there is, again, a large policy error like in the BOJ. So as a result, we have seen allocators that are deciding to wait, some of them, and other ones that are deciding to allocate to strategies that are flexible. We think that in our case, we can capture the turning points, we can capture essentially the speed bumps. And if there is a bigger sell-off, we're also having a good reserve of dry powder to deploy in that scenario. So as you can see, we're pretty excited. We have been able to, in the last few weeks, to monetize some of the weakness in the market and also to buy at relatively panic levels during the week of the 20th post Credit Suisse. So we're happy to follow up with you with any questions and details on the strategy and the process. And thank you so much for your time today.